Welcome, ladies and gentlemen, to another edition of the Grey Market Talk on the Tactical Brief. Torsten Wegener, former retired market maker, yada, yada, yada. And my very special guest, as always, Nic I, former hedge fund manager, extraordinaire, chief investment officer, bond trader, golfer. Well, what can I say, Nic? Thank you very much for being my guest again.
Good morning. Good to see you.
So, what are we going to do today? We discussed that earlier. I want to keep you on the hook. If you stay tuned at the end of our program, I'm going to run a couple of victory laps and show you how you could have made 100% since last week and how awesome our calls were. I'll also show you one mediocre call, but let's focus on the awesome calls. So stay tuned and we dive right into it. I start sharing my beautiful screen. Let's hope that works. Microsoft PowerPoint. Nic, you can see the presentation?
Yep.
See, I can't see it. I have to move it. So I've got it. So thoughts from abroad, waiting for the shoe to drop, and then the chart section. Let's start with thoughts from abroad. Not a big issue today, but something funny. I mentioned that before, that the Alternative for Deutschland, AfD, the so-called right-wing party in Germany, made inroads in the last elections we had in Germany. There are a lot of protest voters voting for this party, and the pretty lady in front of us is Sarah Wagenknecht. She was a member in our parliament of the PDS, the socialists, in the tradition of the GDR, former hardcore socialists. She's left the party and she's now founding her own party. She's very popular because she is intelligent. She has a good media presence, and she's now founding her own party, the Sarah Wagenknecht Party. That's the talk. Why is she doing that? It just shows you communists are actually, they have no shame. Yeah, she's trying to steal now the protest voters from the far right, because yes, a lot of people vote for AfD to give a signal to the ruling parties that they don't like what they is. And socialists really have no shame. If you want to go fishing, fish at your own pond. Don't try to dab into the waters where the sensible conservative protest voters say, yeah, no, we just want to show the normal guys we don't like what you're doing. So, yeah, Mrs. Wagenknecht, well, let's do a detour here, a little one, because she was one of the clever communists. Nic, do you know why?
Go on and break it to me.
As opposed to our ruling parties, she has realized to steal money from capitalists, you have to allow them to make money first. Otherwise, you can't steal it. The guys in charge at the moment, who are officially not communists, don't even see that. Yeah, so the woman is very clever. She said, no. Yes, of course, we have to increase all social standards and fund money for everybody and have a good time. However, first let those greedy, pesky capitalists produce everything, then we can tax it away. So in a way, she's smarter than the guys who are running the show at the moment. Just saying that. My analysis of the whole thing, yes, she will collect votes and she will come with her own party into the Bundestag when elections are in 25. She has enough time to build it up. But that's obviously defeating the object. So you see, that's why we can't have nice things in Germany, Nic. And then the other thing is, obviously, we have a flood at the moment in Flensburg and on all official channels in Germany. The Tagesschau, Heute, very prominent. Oh yeah, in Flensburg we have the highest water level for 100 years. And I have a bit of a sick brain, because when I read we have the highest water level in 100 years, I immediately think, so if you have the measurements, it was already that high 100 years ago. Does that, how much carbon dioxide did we blow into the air 100 years ago if it was already that high and now it's beating the old record? And then I remembered an old article. I don't know whether we had that on the air already, which I read. Somewhere in the Swiss Alps, a glacier was melting away. And they also proclaimed, yeah, well, it's climate change. It's absolute. It's what we are doing. And the archaeologists were actually quite excited because they found underneath the glacier a Roman road. Again, my twisted mind thinks, wait a second. There was a Roman road underneath a melted glacier, so that's 2,000 years ago. It seems they haven't dug up all the snow on ice, put their road in there, and then put more snow on top of it. So it must have been warmer at certain periods in time. So the rationale behind all of that is, I'm just thinking, am I being conned here out of my money? Because if you really want to go after carbon, don't, like we do in Germany at the moment, put up coal plants again because you don't like nuclear power. It doesn't make any sense at all. But that's where we are at the moment. And we are finished already with the thoughts from abroad for everybody who wants to hate a little bit on Germany. Not going into politics because then we have 2 hours talk right now. And go into the economic side where I can draw on Nic's experience, and I've just called it Waiting for the Shoe to Drop and Data Jeopardy. What did we have last week? Nic, will you run us through what we have on the screen?
Well, if you want me to read, it says we had Empire Manufacturing Index. And
what is that? What is that?
Well, it's a state of the manufacturing sector. So actual down, forecast down, previous up. So it was less down than actually forecast. So whatever, make of that what you will. Does it really give us any clues for what's going on in the economy? Frankly, these one-off numbers generally don't. And if you ask people who were probably trading in the market last week whether they noticed that the Empire State Manufacturing Index came out, they probably say, "Oh, I didn't really see that." And I think people are more worried on you know, they want to look at retail sales. They want to see the state of the consumer. They want to see whether or not there's any clues from unemployment. And obviously, last week we got retail sales, which was booming. Plus 0.7, expected 0.3, previous plus 0.8. So for all of these charts that get thrown around on the internet about sort of the consumer is tapped out, no money. Clearly, you know, the consumer is still strong.
It's very interesting. Can I ask you, is that the last hooray? Yeah. Usually just before you go bankrupt, you take the last money you have in the bank before somebody else can take it away and buy yourself, I don't know, a nice dinner or go on a nice holiday. That's always lingering in the back of our mind because I didn't expect retail sales that good. It doesn't make sense. You hear that the student loans repayments have to be picked up again. That could accumulate over a year to up to 200 billion, which is getting drawn out of the economy. At the same time, Biden is in front of the House and is asking for another 100 billion, which he wants to give to Ukraine and Israel. It's all getting out. And there we see retail sales. Yeah, let's burn it down. Let's have fun. It's the best time we ever had. Can you make sense out of that?
Well, there were also bank reports last week, and I think it was the Bank of America CFO who said that he was asked by a journalist or someone on the call, what was the state of the consumer in the eyes of the banks? Because obviously, you know, the banks get all of this data. They can see and they can judge themselves whether or not, you know, the consumer's not paying back their debts or sort of, you know, overextended and all of this stuff. So the banks have the data and they can do the analysis. And I think the response from this person was, you know, there's absolutely nothing that he sees that says the consumer is in trouble. And for that reason, you know, rock and roll, basically. The economy is rock and roll in America.
Excuse my language, but they must be fucking lying. We were talking for weeks now about credit card debts being maxed out to an absolute maximum.
Yeah, well,
they see all these credit card bills coming in. Now people are paying, I don't know, 30, 50% just to pay the interest, never mind redeeming any debt they have.
Yeah, but are you talking about the US government there, or are you just talking about credit cards? They're both the same thing, and they're both, you know, continue. And I don't know if it's a lie, but I would say what's more realistic is the kind of stuff that gets bandied around on YouTube and on Twitter, X. People show you what they want you to see, and so things are taken very much out of context. For sure, you know, debts are increasing. For sure, people are not making all the payments that they should be making. But when you zoom out, it's like your Flensburg water level. Yeah, zoom out 100 years and you realize, oh, okay, that's, you know, it's happened before. And it's when you zoom out on a lot of these consumer kind of debt numbers, you actually still see that the consumer is in pretty good shape.
Yeah, do you know when that happened? 1929 and 1928. That was the dance on the volcano, just before everything blew to bits. Yeah, and I read a very interesting book, came out last week. She's already on the bestseller list. Lynn Alden, highest recommendation. Just get this book into your hands. She went into the history of money and how to interpret it. And there was one very, very interesting thing, which I had. Maybe we can talk about a little bit more when we come to gold later. It was the assumption to say, yes, we have all this money. We are spending it like drunken sailors. And we're permanently being lied to. She had this fantastic bit in there. I read that yesterday evening about the Bank of England, your domain. Actually, when they collected money for the war bonds for the First World War, it was a huge success. And then some economists went into the archives of the Bank of England in 2015. It was buried. They were lying. They only sold a third of the war bonds. Yeah. And the government at the time said, we can't tell that anybody, but we need the money. So what we're going to do is we take the name of the cashier of the Bank of England, relabel it, put some shenanigans in, and print money. So the war bond scenario was actually they needed 1 year's GDP in Great Britain to fight the war against the Germans. They only sold a third of the money they needed in war bonds, so they printed 2/3. And the interesting point I wanted to make, she was going into then, yes, if we have a war, we are in this 29 scenario or in the 1913 scenario, 14 scenario, yeah, that you have these geopolitical risks coming in, and the guys who win the war still devalue by 50% over the next 10 years, and the guys who lose it are completely screwed. Hyperinflation we have in here. And if I see this, we're spending money like drunken sailors. All the numbers we're getting are highly questionable. Let's put it that way. I was too literal with my language a little bit earlier. Apologize for that. But you see what is happening. You see what's happening in the economy in real time. And then we get numbers like this presented, which gives me to the next slide. That was actually my lead up to it, talking about the banks. Yeah, are they lying or are they not lying? I don't know whether they're lying or not lying, but I've called it, the headline is Basel III Endgame. It's a little article, well, one of the leaders in The Economist of this weekend. And Basel III, for everybody who hasn't heard about it, it's basically a worldwide agreement how you have, good conduct in banks, how they should protect their customers, their balance sheet, and
and how much capital they need to put aside.
Exactly. And this Basel III, if it gets installed, and Jamie Dimon was already bolstering about it, the banks would have to increase their capital stock by around 15%. Yeah, they would have to raise new equity, put that in. And according to The Economist, that could take almost 10 years. The consequences of that, I think, if you think about it, what does that mean? You're running a bank. Suddenly, a supranational agency, if you want to make money, if you want to be in banking, tells you, yeah, you have to raise equity, or how are you going to do that? First of all, you're getting more stingy on whom you hand a loan out, right? The risk is getting too big. So that will trouble the economy. Second time, when you do a capital increase, so you go into the markets right now and say, hey, gentlemen, we need another 3, 4, 5 billion. We have some great equity. At the same time, everybody thinks back. So what happened in March? What was the name of this Silicon Bank shenanigans thing was called? That's when you're a big one. That's the positive scenario. If you're a small bank, you have a problem, right?
Absolutely. Absolutely. I mean, we've talked about the state of the banks, right? And we talk about the fact that currently, the banks have got a serious problem. At least, let's just say, if you're not Jamie Dimon, as you call him, Diamond, and
that must have been a Freudian.
I'm sure. But if you're not a large bank, then basically you are suffering outflow of deposit money into money market funds. And the banks tried 6 years ago to basically find another product to offer people, so that people who had their money on interest zero deposit, to move it into a fund which was also created by the asset management of that bank. And you couldn't get people to switch, but obviously they needed to take some more risk. They needed to buy some equity. They needed to buy, and so on and so forth. So, and this failed miserably. So there was many of these products launched, and none of them really came to fruition until now, where there are products, money market products, which basically take the money from the deposit account. They go into a money market fund because the money market fund pays them a shed load of money, or T-bills, or whatever it is. That's all they buy. You're earning 5% plus. And so the money is coming out of the banks, and the big banks can afford it because, money goes out, but money comes in from the small banks, from depositors who are a bit worried, say, well, I'm not sure I trust my small bank anymore. The consequences of this are that it makes it more and more difficult for certain banks, certain small banks especially, to make money, because now they're having to raise the deposit, the interest rate they pay on deposits, and that narrows the gap between what they're earning on their loans versus what they're paying on deposits. And we haven't even begun to talk about the fact that the small banks are more exposed to real estate, and I talk about commercial real estate, they're more exposed to real estate, and therefore it makes it much harder for them to actually make some money. And then you get somebody tap on their shoulder and say, oh, by the way, you probably need to raise your equity. And I don't know if that's, a current story and whether or not they're going to be excluded or not. But, then you get the idea that what is the role of a small bank going forward? Does it have a role? And the answer is probably less and less. And there will be less and less small banks.
I will mention that in the pre-talk to Nic, because I remembered something from 87, an article I read. It was an outlier opinion, which said, no, the crash in 87 did not happen because the market was overvalued or interest rates were going up or there were all these selling programs. It was a little piece of legislation which prohibited takeover companies who identify takeover targets to deduct the interest they had on their targets as they did before. And I thought, or the author thought at the time, it's the little pinpricks that actually could pop a balloon. And that's when I came across this Basel thing. I thought, yeah, nobody's going to talk at the moment about Basel III. So let's make a little topic here between us, because everybody's talking about oil, about the Middle East going on, inflation, and the EZB, and does Mr. Powell get it right or not? And I thought maybe that is one of these little pinpricks that could blow the whole thing up, because opposed to Sarah Wagenknecht, they had, they had banks in the GDR, in the DDR too, in the past, but they weren't proper banks. So banks have a tremendous function to have a wealthy economy. And if we are strangling now the banking sector, and that's where I'm obviously with Mr. How did you call him? Demon? JP Morgan's boss, Mr. Demon himself, yeah. That is a stupid idea, because as you just elaborated on, it will kill the small banks. And I have already the next slide, because yes, we're not talking just about commercial, but it fits in. The median home prices are contracting sharply. A beautiful chart from Game of Trades in here, which is also coming everything into the whole financing aspect. And the one thing I've learned from Nic over the last couple of weeks, if you see a chart like that, for everybody who's just listening, you see lows in the median home prices. In 1970, big recession, 2008, big recession. And at the moment, we are again in 2023 at these levels. In the past, I always thought, yeah, that doesn't look good. It's going to be a nightmare. What I learned from Nic is the other way of looking at it, like I did it with high water and the glacier meltdown. Well, if home prices have contracted so sharply already, is it time to turn? Is it time to turn, Nic, or what are we seeing here?
Well, you are seeing medium home prices. I don't know, the data that they're looking at, but this is for new homes. And I think, we know that the residential sector, which is on new homes, is struggling. Of course it's struggling. You've got a mortgage rate of 8%. And for people who were saving up money to buy a new home, clearly, they're going to have to pay a lot for their monthly payments. So it's very difficult for all of these home builders to charge as much as they have in the past charge. So therefore, they have to have a big discount on this thing. But if you look at the actual wealth in America, the wealth has increased substantially in the last year. Since 2019, there was a recent thing on the internet. The wealth has pretty much has increased incredibly because the price of their residential real estate has gone up so much. So when you look at a chart like this on 15% of, let's just say, the residential market, the 85% is the thing that's made everybody very wealthy in America, and that's why people continue to feel comfortable about spending and the like.
It's the wealth effect in there. I'm absolutely with you. That is a fantastic slip to the next chart. What are we having on here? Consumer spending and consumer credit, because that fits in quite nicely. Total non-revolving consumer credits on a monthly percentage change are down again, like they have been June 2009 and like they have in December 1990. They're down minus 9.8% according to the slide, which is from Refinitiv as of August 2023. Obviously, you could see it the same way you are seeing it now. Yeah, it might turn around, and as consumer spending indicates, everything is fine, everything's hunky-dory. The only thing that made me a bit concerned, the earnings call from Tesla last week. Yes, of course, I'm jumping back and forth, but Tesla is basically a high-value consumer good. Yeah, if people need a car, they buy an old banger to go from A to B. If you spend a huge amount of money on a nice Tesla in the United States, and Mr. Musk sounded not very upbeat in the earnings call. His margins are coming down where normal car makers are at the moment, and they're being identified as, well, the growth stock you have in the US. So if I look at consumer spending and say, fine, people are putting the money they have, the spare money they had, into their mortgages because they're now paying huge higher rates, they're spending less on consumer goods. Consumer goods, then you have a Mr. Tesla here. And his stock is, well, how many short sellers have died over the years by shorting Tesla? Quite a few out there. Yeah. However, it was always this, there is the genius, Elon Musk, and he's producing something people really, really want. And now they have difficulties actually to afford it. We know since the beginning of the year, the prices have been reduced on their X and S top models by around 25% already. So there must be a huge backlog of cars he wants to get into the market. Otherwise, you don't reduce prices. China is competing in this market massively. In China, which is one of the biggest markets, and with the earnings call from Mr. Musk not being very upbeat, because in the previous quarters, he was always, yeah, let's do it. Let's go. It's fantastic. That really made me think that it was like I initially said, it was the last hooray in consumer spending. Yeah, let's blow up.
What you're saying and what you're sort of alluding to is that what we're seeing isn't necessarily what we will see for the next months to come, and perhaps people like Elon are looking at their data, their order books, and saying, actually, you know what, this isn't what we've been forecasting in our management base case, and where is this coming from, and what is it that drives consumer spending and consumer sentiment? It's all about confidence. And if you lose confidence, and if it's the exact opposite in China at the moment. China, they opened up after welding the doors shut, so not allowing people out their houses, and they were hoping that people would just come out and go and spend. Well, they're not spending, they're saving. Savings rates are massively increasing. Why? Because the consumer still doesn't have confidence in the economy, and perhaps therefore for their own job and therefore their future income stream. And the thing that, if you ask me, what would I be worried about right now? We looked at some numbers. The employment numbers also came out last week, so initial claims or something like this.
Yeah,
there wasn't any sign of any employment problems, but there is something called, I think it's the WARN Act. And basically, before companies in America fire sort of more than a certain number of people, they have to kind of discuss with unions. Like in Germany, you have to sort of make this thing a little bit public. that actually you will be doing something in the future. And it could well be that what's going on and what these people are seeing in some of their order books is that the future state of the consumer is perhaps, at its, or we are at the tail end of all of this spending spree because, and this is where the confidence comes in, if you think you're likely to lose your job, or if there is a action in a company which basically says that they need to reduce staff because of cost, because of artificial intelligence, because of whatever, then your confidence will sort of wane. And the numbers that I saw from this sort of WARN indicator showed that unemployment will start to increase, in the near future. And remember, the last shoe to drop, as it were, unemployment is a very lagging indicator. But if there are signs, early signs at least, that unemployment will start to tick up, that's a very dangerous thing for an economy. And obviously, this is not necessarily Jay Powell will wait for, to see the unemployment people, in the job queue. But if forward-looking indicators say that there could be a problem, then, we should start to take note, and it should be on our radar. Up until now, I've been fairly chilled out because the numbers have been sort of reasonably good. But there are forward-looking numbers which basically say, there might be a problem going forward. And that then has a spillover to consumer confidence and so on and so forth. And that's, as a really important thing to be watching for.
I've just pulled up the leading indicators, by the way, for everybody who's listening on the chart, which is basically confirming what Nic has just made a point. We were talking about that, obviously, in the pre-show, about jobless claims. Yeah, jobless claims is the only positive contributor to the leading indicator by the Conference Bureau, which we had in September. And then, obviously, jobless claims, job market is the laggings of lagging indicator. That's why I found that very interesting. Something you have learned from Nic about this indicator. If it's forward looking and it's already confirming what people like Elon Musk must be seeing out there, and what the guys from Bank of America apparently don't see, that people are not stopping their consumption, then you come into a scenario where you have Americans who have a different spending and saving habit than the Chinese or the Japanese. Richard Koo, could you call it inventor or the discoverer of the balance sheet recession, he made a topic out of that. When people, even if interest rates are coming down, they are not investing it, they are saving it, they're putting down their debt as much as they can. If you have a global scenario where China, where Mr. Koo is speaking a lot at the moment, sees a balance sheet recession on the cards, while in the United States, the consumer eventually will not be able to save anything or to buy anything because they've blown everything out of the window while they had the chance to buy some nice things. We're not talking about a modest recession, global recession anymore, Nic, and obviously I'm the doomsayer here again. We're talking about a bloody disaster in the making.
Indeed, but if we're going to get our clues from interest rates, remember the clues, in my view, and this was something that Milton Friedman sort of reiterated, he called it the interest rate fallacy, is when you see interest rates going down, it doesn't mean that it's because there's a bunch of liquidity and, everything's fine. It actually is a sign of tightness in the economy because as interest rates are going down, people don't want to borrow, they don't have enough confidence. Now, if we look at the converse today, sort of to counter your argument, interest rates are going up, means there's an abundance of money, it means that there is enough confidence and so on and so forth. So, we can't sort of use the interest rate story per se. If you start to see interest rates going down, it is because, people have no interest in borrowing money. And obviously, no one's interested in borrowing money at 8%. If there are no projects out there that earn enough to cover the interest rate costs. Yeah. So today, a high interest rate level is reflective of a strong economy because even at high rates, the economy is still moving up. And we've talked about why that is over the weeks. This is not something that we can, judge in the current scenario because of everything that's happened post-COVID that has totally screwed up all of the interpretations and numbers because people have borrowed already for a long period of time, both for housing and for companies. and therefore they're not really impacted by the high rates. The only people that are impacted really by the high rates are, the US government. And you showed the Russell. Did you show the Russell 2000? No, you didn't. So I won't say anything about Russell, but obviously smaller companies where they have they've not been able to borrow aggressively in the capital market. So small companies can't borrow for a long period of time. Large companies can. So the smaller companies are more vulnerable to higher interest rates because, they will have a much sooner refinancing thing. And if you remember think about when they borrowed money in the first place, they had a project or a reason to borrow it. Now, if their project can't take, 5, 6, 7, 8, 9% interest, whatever they have to pay, then these smaller companies are going to struggle. And that's why you might see some strains in the small cap indices.
Yeah, I get the Russell chart out in a minute. No, you said it over and over again. The special situation for the economy in the US is fiscal policy. They're spending like a drunken sailor. Yes, and all this money is still sloshing around in the economy. If they can keep going, yeah, fine. Venezuela, go long equities. Nobody cares. Money has been done. But I see them eventually, like your famous prime minister said, eventually will start running out of other people's money. And that's
true. That is true. And you have to also try and sort of link, GDP growth. There's been, you've been asking me, where's the bloody recession? And I said, well, we haven't got a recession whilst the government is printing, whilst the government has got a deficit. And how big's the deficit? Well, deficit versus GDP, 6%, 7%, whatever the number is, reasonably high. What's GDP? Nominal GDP, not real GDP. Real GDP is forecast around 2.5%, but nominal GDP, let's just say, is around 5-6%. Well, I mean, it just goes to show it's all the government. It's all the spending from the government, which is actually sort of creating all of this growth. And if they didn't run deficits, then America would not be the same. Yeah.
Yeah, I'm with you. Excellent, perfect segue. Let's go into the sectors which could benefit from government spending or not. Do you have the slide on your screen, Nic?
Yes, I see it.
Yeah, so we have the sector spiders over here. And let's see. Let's go on year to date. Because everybody likes the slide I put up in a minute with my playbook to get an idea. And what we're seeing here in front of us is actually confirming exactly where we have been data-wise. We had a reflation Goldilocks scenario, sometimes a little bit more to the Goldilocks, other times a little bit more to a reflation scenario. And we're exactly long the stocks we should have been long year on year or since the beginning of the year. Yeah? Communication service, consumer discretionary, technology. And if I go now,
and before you switch, or it doesn't matter, the consumer discretionary versus consumer staples. So things where nice to have, that's the discretionary, and consumer staples, things you always buy. Walmart, I guess in America would be classic, or Coca-Cola for you is a consumer staple, I'm sure. So the discretionary item. Are those things that consumers don't have to buy. And if you look at the ratio, and one of the sort of key indicators to follow is the ratio of discretionary to staples. And if you look on a year-to-date basis, it's clear that discretionary versus staples is very much in favor of discretionary. And at the moment, and I think you were just about to push the button, let's see how those two play together. So the things that have worked have been, so discretionary now.
For everybody who doesn't see it, we have it on a month basis now. Consumer discretionary is down 9% and consumer staples are down 5%.
Now, you see, on a year-to-date basis, that was showing a very strong tendency for the consumer to say, I feel confident, I can buy stuff, even stuff that I don't really need. That's the discretionary element about discretionary. And that was, bullish equity market. And the moment you start to see this ratio change, so if you do, let's just see what it was 3 months. I don't know what the answer was. You press 3 months. So that was the turning point where the two of them on a sort of performance basis basically At that point, it said market topping, right? And then you just did the 1 month. You can see that discretionary has underperformed staples, and that's a negative indicator. So these are probably much better than any economic number, which is so hindsight based, that you read off the screen. Much rather look at things like this, because they really give you a clue. They're kind of live. They tell you what the market is really pricing into stocks. And you can see when in the last month, discretionary staples, people are really worried. So the stock market investors are starting to worry. Or at least they have been already 3 months ago, and now even more so, right?
So looking at this and flipping up the most favorite, wait a second, new share, PowerPoint, share. You see it, the business cycle, the quad model playbook, Nick?
Yeah, I can indeed.
Okay, so taking this into consideration, obviously we've played for a year recovery and expansion, or Goldilocks versus reflation, however you want to call it. When I have this chart in front of me, my first, being a volatilities guy, always goes on the volatility indicators we are seeing here. And we've seen that. We have seen the VIX trading at 12 while the market was moving up. And the MOVE index wasn't doing a lot. What we see at the moment is volatility trading above 20 in the VIX, MOVE at around 155, stable. Well, no shit, Sherlock. What we see in the bond market at the moment is obviously confirmation. What we are seeing as well on the yield curve side, and that is one of the puzzles I have. We have now almost a flat yield curve, Nick. How does that fit?
Well, the yield curve is the yield curve. The short end is driven by the Fed. They are able to influence the short end. The 10-year, just talking about how the 10-year.
Let me try to get the charts up while you're talking.
Okay, how the 10-year gets influenced by the Fed. If you were to sort of just create a very rough rudimentary model of where 10-year yield should be, I would say one model, which is not unreasonable, is to say, okay, roughly I'll put a third of the yield of the 2-year, which we know is influenced by the Fed, plus a third of GDP real, plus a third of inflation. And then you've got a very rough idea of what the 10-year yield should be. And I think if you did that number, that calculation, you probably end up around 4.5% or thereabouts as being a fair price for the 10-year. So the Fed influenced the 10-year because part of the kind of the thought process of a 10-year investor is, how am I being paid for, versus the short end of the market in order to take the risk. And for the 10-year investor, also he's considering about future growth. And what investors got totally wrong, towards the end of last year and the beginning of this year, was they basically said recession. So they were looking at those two components, if you like, the kind of the real GDP as being sort of down and negative. And therefore, that's why you had a negative yield, a downward sloping yield curve. So you had the positive influence of the 2-year, but they were building in a negative estimate for the GDP component, and for that reason, that's why you had that sort of downward sloping. And now, obviously, there's been an adjustment process. Part of that adjustment process, the 2-year is still roughly the same as it was. But obviously, they have had to adjust to the elements which are due to, to the stronger growth. And if you look at the GDP now forecasts from Atlanta, they're saying that this quarter nominal should be something like 5.4% or thereabouts. Real GDP is a lot stronger. You can add to that, obviously, the fear of what's going on with the fact that the Treasury have to fund around in excess of 10, 11, 12, 13 trillion over the next 2 years. There is this supply concern. So there is this fear amongst investors in the long end of the market is, who's gonna buy this stuff? So you've got two things influencing 10-year right now. One of them is a supply, and the other one is an adjustment process from the market. Say, oh, actually, maybe we're not going to get the recession. I know that there are so many people who say it's nothing to do with growth forecasts. It's all to do with, something else that's going on. There are things that influence the 10-year, and growth, inflation, and short-dated yields have kind of always really worked as a good guide. And so that's why I see this natural adjustment process going on in the yield curve. And the Fed can't influence that. They can only influence the short end of the market. And obviously we saw Jay Powell this week. You had it as well. What happened this week? I didn't comment on that. Should have done perhaps. Jay Powell basically said, it looks like the rise in yields in the 10-year is having a kind of a restrictive component to financial conditions. That's a good thing, isn't it? Because surely we did that with our raising, that's how central banking works. He didn't really do that. It's just that I think the market got it wrong and is now adjusting to that thing. But it is restrictive, right? We mustn't forget that having 10-year yields close to 5% is very restrictive. It is also systemic. So there are systemic problems of having yields rally so far, so fast. And we know that from the Bank of England. They could tell you stories from last September, October, when yields gapped up and the Bank of England, who are in a quantitative tightening mode, had to go into a quantitative loosening mode and pump a lot of liquidity in order to cap the yield. Powell is not stressed by the 10-year yield, and that's why I think more people felt comfortable that, therefore, he's happy to let this thing go up, and that's why we saw another move up towards 5% after he spoke. And the reality is they can't be ignoring what's going on in the market, and the systemic impact are things that the Fed seem very, very bad in monitoring. There are correct analysis of bank balance sheets. We talked about it last week, where at the end of the day, a lot of banks who own this stuff, they probably have to hedge this stuff. That adds to the selling pressure because their capital is in danger of being wiped out. And, this is, if you're a bank and you own this stuff, you don't want to show negative equity, even if the central bank give you the capability of putting, your bonds back to the treasury, and then they lend you money at 100% of what you're giving. If your capital is negative, this is something that equity investors will almost certainly wipe out your stock. And there are a number of banks at the moment who are on the kind of the death list, as it were, and they need to be careful. And the Fed needs to be less sanguine about the rise in yields.
Yeah, Mohammed El-Arian said that, sum it up, he basically said they got that completely wrong, they should have stopped raising rates months ago to get that right. And the usual playbook for me, I'm a couple of years in the market, you've seen that as well. Yes, the yield curve inverts, and then the equity market is still running until we see a steepener, and then the equity market starts tanking. However, when we talk about a steepener, we usually talk about a bull steepener.
Rate cut, absolutely right.
Which means the Fed is pumping down the short-term rates where they have influence. Now we see a steepener where the Fed keeps the level high at the short end, and the long end goes even higher into the steepener. And what I'm lacking here is the understanding. Is my scenario still right? Are we going to see a big dump, or is that something, I use the evil word again, something different now, having a bear steepener in a scenario like this? Does it really indicate all your recession talk, Torsten, is complete and utter BS? The bear steepener we are going to see in a reflation scenario.
Look, I mean, we can tackle these issues one by one. As I said, if you think of a very basic model of where the 10-year should be, it's based on short-term rates and it's based on growth expectations. Up until now, the market has said everywhere and wrongly that there would have been a recession, and therefore that's why they build in where should 10-year yields be. When they have to adjust to that and they realize, oh, shoot, there's no recession, they do have to adjust the estimate of where the yield should be in the 10-year, because they have to build in higher GDP estimates. And that, for me, the formula tells you where the yield should be. It's very rough, it's very rudimentary, but as I say, and you combine that with a lot of supply fears, which is not being supported by foreign investors, it's not being supported by quantitative easing by the Fed. It's in fact being the opposite. So you've got the supply thing. You can understand why the yield curve is moving today the way it is. But you ask about, are we going to have a recession? Well, for sure. Tightening financial conditions. The Fed are kind of looking around saying, yields are at this level right now. I wonder what impact that will have. They honestly don't know. These people are not so clued up about what impact these things are going to have. And there's also the systemic problem of bank balance sheets at much higher yields. And so those are two things where I'd say you're not going to get your clues from the Fed's words. You're going to get your clues only from Fed action when they suddenly see things fall apart and the wheels come off. Then they will jump in, because they tend not to jump in advance, because they don't see it, and B, well, if it's not burning, I don't need to put some water on it. And that's been their policy throughout. And at the moment, I sort of, to finish off, Mohamed El Alian, I didn't see his quote, but it seems identical view to mine, that effectively the Fed should have stopped a long time ago, because the economy as it is, you won't see the burning, that's taking place until people start to refinance, until, all of these things will happen probably next year. And a lot of these market participants are looking forward and saying, I can't see the Fed slowing down. Surely they can see this, and they can't. And you're still hearing idiotic statements from Fed governors saying, whoa, we're not tight enough. Sorry, but this just basically is, when you hear that, you just think, why should I invest in anything? But final comment, sorry. Is it all going to burn down? It's all about relative value now as well. Are bonds cheap enough to offer value versus stocks? And my view is, yes, most likely the equity risk premium has declined. Yes, equities are still are more expensive than they used to be to bonds, but equities still offer growth potential. And, that growth potential really does depend on what happens to the economy. And if the economy survives, and that's not just a US economy, it's the global economy. China, remember, is not switched on right now. China is in negative. So there is still upside if the Chinese get their act together. And so for that reason, I'd say that, there is still a case for equities. I don't see that as being something to be concerned about. But then you put this chart in front of me, which basically says, Nick, surely that looks ugly. And I'd say, yeah, it doesn't look pretty at all, does it?
No, I actually wanted to show, I pulled the S&P chart up, and we all know what happened last week, especially towards the end of the week, because Nick wanted to talk about the Russell 2000. Yeah, what we are seeing here is, for all technical aficionados, we are fencing with the 200-day moving average in the S&P at the moment. As my chart shows at the moment, we seem to have closed below. No reason to panic yet. Yeah, if we don't close above over the next week, then you should get technically concerned what's happening. But we also looked into the Russell 2000, and that actually shows also a confirming picture. But because what people always forget is equity markets are one of the finest leading indicators for the economy. Yeah? And Absolutely. The equity market, for at least for the last week, shows us S&P. People are getting a little bit nervous. And then we look at the broader market, the IWM, the chart I have in front of me. We're here at a critical situation, aren't we, Nick?
Yeah, I mean, I think it tells you the story of what what we've seen in equity markets in general, and that is that the things that have gone up this year are been due to flow of funds, and the flow of funds into the States for all sorts of reasons obviously goes in because of how these ETF products are constructed. They all go to Apple and Microsoft and Amazon and all of these famous names, these FANGs. But the S&P 493, so 500 S&P stocks, less all of these, high tech stocks, haven't really performed this year. And I think you're flat or even slightly down in equities in these 493 stocks. And that just shows you that not everything is as good as the growth numbers show, because effectively companies are, they've got the outlook for companies is poor whilst interest rates remain so high, because the closer and closer you get to refinancing debt, and we know the world is all about refinancing debt, the closer you get to that refinancing point, the more troublesome that's going to be for your projects and your longevity and so on and so forth. This is Russell versus Qs, I can see. So the small cap versus technology. I mean, these are things to watch. I mean, I wouldn't say my drop dead number, but my drop dead number for the S&P is around 4,100. Below that, there are, sort of dire scenarios. There are sideways scenarios. We have to watch it. Here again,
it's got the S&P on again, because we spoke about that last week. It's almost we are at this. Can you buy the dip now, or is it time to wait for the confirmation? Having said that, there's a time to buy, there's a time to sell, and the famous saying goes, there's a time to go fishing.
Yeah, absolutely.
What I need now is some confirmation somewhere to the upside or to the downside.
So the best time to buy something is when you know you're wrong fairly close by, right? So if you know you're close by wrong, when there's, let's just say, an overlap on the downside that, let's just say, your chart suggests is problematic, and if that number is 4,100 because it's sort of roughly the high that you saw just before, so November, December of last year, I don't know what date that is, and if you overlap that, then from an Elliott wave perspective, that's not a good sign, because we've only had what looks like 3 waves up, and that becomes, from an Elliott wave perspective, problematic, and therefore there are 2 alternatives for that. Either we go to new lows, or we're just going to trade in a very sideways, long sideways pattern for a long period of time, which is also, oh God, yeah, you see 3 waves. I say we've only done 3 waves, and look at that. Your machine says we've only done 3 waves, and
that's TradingView. It's a beta, and I clicked that up because I don't have a clue about Elliott wave. I just thought.
Yeah, but that's absolutely right. What it looks like, and 3 waves, and you see he's in this thing, right? Elliott wave basically says a move in the main direction has 5 waves, and a move against the main direction has 3 waves. So if we can, based on what this chart is showing, is 1, 2, 3, and then it's got a 4. Which implies there's going to be a 5, and you can see the 5 is forecast above at 4,900, which is my sort of first target. And then the alternative is 5,300, and the alternative above that is 6,000. And those 5s are being forecast, it looks like, by your beta model on a Fibonacci basis, based on the length of either wave 1 or the length of wave 1 and 3. And that's how Elliott wave works, and I've used it for 20 years, and all kind of makes sense. The downside of this picture is that it won't count 4 anymore if prices, where we are right now, it says 422, 415. You can see that in red on the right-hand column, 422, 415. That's where we are. If that price goes above below where the number 1 is shown in brackets in blue, right, which is there, or The one below that, actually. So I wouldn't count it that way. I would say the one, if you just go to slightly to the left, it's not numbered, slightly to the left, or slightly to the right, there, roughly there. So roughly, no, left, there. So that was the last sort of point where I actually have my number one. He's labeled number one somewhere else. Okay. But my number one is at that level. And you can see what the high there is around 4,100 in my eyes. So if we were to break that number one, my number one, not his number one, then the structure would finish with 3 waves. And if the structure finishes with 3 waves, then what's likely to happen is a move back down to the lows. And that's how kind of a basic Elliott wave interpretation would be. And as I say, don't use his number one. I don't think he's done it correctly, but we trade charts right now.
It's their algorithm. I think we should do a special about Elliott wave, where you can teach us a little bit about a couple of quite interesting charts, especially if the development is like it is. But you gave me a fantastic segue. I promised right at the intro, I'm going to show you how you could have made over 100% in a week's time. No, I'm not talking about the DAX call we got right as well. If you remember a couple of weeks back when I said I don't giving recommendations because this is not about recommendations. We're not allowed to do recommendations. We're not doing it. Yeah, that's the disclaimer. But hey, why the hell would you go DAX long at these levels? And we lost 9% since then. However, last week I showed you something where we had already this ambiguous situation where we thought, okay, fine. Are we going long or are we going short here? Nick made a case why there is still some juice left in a bull market. Yeah? And I said, fine, I could agree with you. If you're an investor and you have a large portfolio, in a market scenario, the playbook showed us, we still want to be long. Yeah? We want to be long high beta stocks. But what do we also want to have? We want to have a hedge in there. And my good friend, the chartist and man who looks at the algorithms, gave me, let me try to share this because it's too nice not to share it. Made a very interesting point and said he's going to see till, what was that, Thanksgiving, the market going to the region of 3,900, 3,750, somewhere even in that ballpark. And I showed you on the screen, don't find the bloody share thing. I'm trying to vamp here, Nick. Help me out. Where is the button to share things on?
I wish I knew.
I'll get there eventually. I just have to click everything down because in my younger days I had 6 screens in front of me. Now sitting at
the good old days.
Yep, I only have 2 screens in front of me, and that is obviously not enough here. We have found a share screen, not enough to show up. So this is, you can see it now, yeah. Yeah. This is actually not my trading book. This is the YouTube shot from last week, where we said, okay, fine. If you want to have a tail hedge insurance for this unlikely scenario that the market taking a big dive, you buy the 3,900 put on the S&P with maturity 30th of November, end of month, and you sell the 3,895 against it. So we have a digital option. If we end up below 3,900, you make a lot of money. One contract would cost you $20, and you could make a max profit of $480. And now I'll try to share again. New share. What we see now, I have to click up the live trading book, and obviously I'm being a little bit facetious here. No. New share, where is it? Tasty trade. You see it now. Yeah? That's the situation we have today. Obviously, we had a little selling program towards the end of the week, but the thing you would have paid $20 last week is now worth 45. That doesn't mean you should cash in and take the money and have a big party with it, but it just shows us the importance of having a tail hedge in place. I still assume that this thing will expire worthless. And we're not going to see the 3,900 till the end of November. But it's good to have something like this in your books, even for a small amount, and you can see the velocity with which these tail hedges can move if the market shows a big move with big acceleration in one or the other direction. So I just want to put that on to everybody who waited through our conversation, did see that we have this on the screen when we talk about volatility. It's not just because I like talking about volatility, but it makes a lot of sense to have an eye on that. Nic, do you have any last words after I did some bragging now?
No, I think the bragging is absolutely important because it just goes to show you. And you know, one thing I've said is that going forward, making money from buy and hold investments is going to be very difficult. You're going to see a lot of noise. You're going to be tested every single time. You're going to be nervous every single time. And, you know, over a long period of time, you'll make your 7%, whatever it is, return, but you might have lost a little bit of hair along the way. And what's most important is to manage, you know, things over that time. And so opportunities like this, when they present themselves, to sort of enhance the P&L and protect your portfolio, you know, which is sort of sitting, you shouldn't start to trade your portfolio in and out. It's usually very expensive when you do, because not because of the transaction cost, but you almost certainly won't get back in again. So you need these kind of overlays along the way, and therefore you need to get this skill.
Thank you very much. Fantastic last words. I hope you enjoyed our show. Please subscribe, share, and comment. And we appreciate seeing you next week again. Thank you very much, Nic, for your time. Thank you for watching our little show, and have a very good weekend and a very successful week ahead of you. Bye-bye.
See you. Bye-bye.